You dropped $3,000 on a tax strategy question, and somehow that's the most relatable thing a real estate investor can do in today's market. Let's figure out if that question is worth asking, or if you're already ahead of the curve just by asking it. Cost segregation is one of those terms that sounds like it was invented by an accountant who wanted to feel like a Navy SEAL, but at its core, it's just a way to depreciate your property faster and pay less tax sooner. Think of it like this. Instead of the IRS slowly draining your returns over 27.5 years, you're essentially asking them to front-load the pain and reward you now. Here's the setup. You buy a $300,000 rental property, and your CPA tells you the whole thing depreciates straight line over nearly 3 decades. But a cost seg engineer can reclassify the flooring, cabinets, landscaping, and fixtures as 5, 7, or 15-year property unlocking accelerated depreciation in year 1. With bonus depreciation, which hit 100% under the Tax Cuts and Jobs Act and has been stepping down since the timing of this strategy has never mattered more and also never been more confusing. We went from depreciate everything immediately to a slow phase out, which means the math changes depending on what year you're playing this game. The study itself costs somewhere between $3,000 and $10,000, depending on complexity, which is why that $3,000 question on a $300,000 property is genuinely interesting. That's 1% of your asset value just to find out how to keep more of your own. Money. The industry rule of thumb says cost seg starts making sense around the $300,000 mark, which means you're sitting right on the knife's edge. Here's the irony though. The investors who need this strategy most are usually the ones least likely to have the tax liability to absorb the deductions. If you're a W-2 employee without real estate professional status, your passive loss limitations could turn those shiny accelerated deductions into a deferred parking lot that does nothing for you right now. But if you or your spouse qualifies as a real estate professional under IRS rules, meaning over 750 hours per year in real estate activities and more than any other profession, then suddenly that $3,000 study could shelter tens of thousands in ordinary income. That's the hidden lever most people miss, and it changes the entire calculus of the investment. History rhymes here in a way that's almost poetic. High-income earners have been using cost seg since 1997 when the tax court ruled in Hospital Corporation of America versus Commissioner, unlocking the strategy for everyone. The wealthy figured this out decades ago, and retail investors are just now waking up, which is either inspiring or deeply unfair depending on your mood. Let's run the numbers honestly, because that's what actually matters. On a $300,000 property, a cost seg study might reclassify $60,000 to $80,000 worth of components into accelerated categories. Assuming a 30% marginal tax rate and favorable bonus depreciation rules, you could be looking at $18,000 to $24,000 in tax savings against a $3,000 study cost. That's a 6-to-1 or better return. Now, the skeptic in you, and frankly, the skeptic in me, wants to pump the brakes, because this assumes you have taxable income to offset, you're in a high enough bracket, and you're not going to sell the property in year 2 and trigger depreciation recapture that claws everything back. Depreciation recapture tax sits at 25%, and a lot of excited first-time investors forget that the IRS has a long memory and a very patient billing department. The practical lesson here is not whether cost seg is universally good or bad. It's whether your specific tax situation, hold period, and income profile make it a lever worth pulling right now. A qualified CPA who specializes in real estate can do a free or low-cost feasibility analysis before you ever write that $3,000 check. And if they can't give you a projected ROI on the study itself, find a different CPA. The discipline here is refusing to be seduced by a strategy just because it sounds sophisticated. Cost seg is a tool, not a personality trait, and the investors who treat it like one tend to over-optimize on tax efficiency while under-optimizing on deal quality. Your best tax year means nothing if you bought the wrong asset at the wrong price. If the math works, and for many investors at the $300,000 threshold with the right tax profile, it genuinely does, then this study isn't a cost. It's the cheapest capital you'll deploy all year. The goal was never to avoid the question. It was to answer it with enough data to make the outcome feel inevitable either way. At the end of the day, Investing is a game of process over prediction. And the investors who consistently win aren't the ones with the best tax strategies. They're the ones who know exactly which strategies apply to them and execute without emotional noise. Whether the cost seg pencils out or not, the fact that you're asking the question means you're already playing a different game than most people. And if you want help getting into that game, whether it's finding your first investment property, connecting with a contractor you can actually trust, or locating a lender who understands real estate investors, check out our links in the description below.